It's good going on the markets, and all that is in anticipation that the budget is going to deliver something big. So on only the tax front, let's check out what tax experts are expecting. Dinesh Kanabar, like I told you, CEO of Dhruva Advisors, Sachin Menon, the head of Indirect Taxes at KPMG, and Sudhir Kapadia, national tax leader at Ernst & Young, are joining us in this discussion. Well, to you, Mr. Dinesh Kanabar, first up, what's the most likely expectations on the tax front?
So I think from a corporate perspective, and we'll have to look at two separate perspectives. One is a corporate perspective, other is the individual perspective. I think the key issue which people are looking at is, I can break it up into two baskets. One is what is happening on the minimum alternate tax, or the book profit tax as we call it. First, in the context of SEZ, where there is this huge pushback to say that if you want the Make in India to really be successful, is this something which you need to do away with? Similarly, in the context of foreign institutional investor, where there is this huge litigation staring at us, that if you are an institutional investor without a presence in India, not maintaining books of accounts or in India, are you liable to a minimum alternate tax? I think this is one thing which all corporates are looking at. The other issue is on general anti-avoidance regulations, and everybody is looking at keenly to say that the provisions which are otherwise to be effective from 1st April 2015, are they being pushed back, and if so, for how long? I think that's a very significant clarity which corporate India is seeking, and one is hoping that the finance minister will be able to deal with this. From an individual perspective, two key things. One is whether the exemption limit is being revised upwards. I think it's a very critical thing. Second is whether incentives on certain things like investment in houses, repayment of loans, interest, etc., become more tax deductible. But beyond all these tax issues, Lata, the key issue is going to be how is the budget going to spur further investment and going to give a boost to the economy and give buoyancy to the tax revenues, is something which everybody is looking at.
Okay, Mr. Kanabar laid out some very important points. Let me go to Mr. Kapadia. Mr. Kapadia, you know, the big case of tax uncertainty has been the demand that FIs be exempted from MAT. What is the expectation this time around? And if there is no clarity on this, then what could the outcome be?
I think, to my mind, this is an invented issue by maybe some overzealousness on part of the tax administration. Because I think if I look to the intent of a provision like MAT, I don't think the intent is to imagine books of account being created in India for institutions like FII. It's a very simple provision, capital gains. There's a self-contained code since 1992 for FIIs, taxation in India. In fact, the last budget liberalized that further in the right direction by saying that even if you constitute investment management functions in India, the FIIs will not be, considered to have a taxable presence in India, which is what countries like Singapore, etc. offer. In fact, if you ask me personally, I would not be surprised if not only this MAT issue is clarified to say that it should not apply, but I would not be surprised if the finance minister also announces that this clarification on not creating a taxable presence by merely having investment management functions in India will extend beyond FI to FPIs as well. Okay. Because that's the way to attract funds in India. Why do you need to set up in offshore jurisdictions if you can get that certainty and clarity here? And that's the best way to in fact increase the allocation of these investment flows to India. So that's what I am expecting, actually, quite contrary to this concern about the MAT on FII. In fact, that would anyway go away or be clarified, is my own sense. Okay.
And what about this entire Make in India initiative, since that is clearly the defining theme of the Modi regime?
Yeah, it's an interesting topic, Lata, and I would just step back and say, as a matter of tax policy, what is this Make in India impetus about? Is it about removing the red tape? It is about reducing the number of permissions required? Is it about, frankly...
It certainly is that.
Yes, yes. So now, the question is that if you go back to the direct tax code, which has been forgotten now, and the direct tax reforms, right? The philosophy enunciated therein was that, like in most other parts of the world, and US is going through that same discussion, the corporate tax rate should actually decline. but also the number of profit-linked exemptions and deductions, because the latter has clearly resulted in unwanted distortions, controversies, uncertainty. So a simple thing like surcharges, which are there forever now, and which I have been saying year after year without effect, to say that corporate tax rate should come down to 30%, which is still not very high. Now, in the bargain, I think any government of the day would say that, look, yes, we do that, but then we have this plethora of exemptions, and I think industry should debate this point and say that on balance, would you prefer a much leaner tax code, simpler tax code, and more moderate corporate rate? I personally think the latter would be preferred by a lot of industries, because you look at backward area benefits, you look at export related benefits, the kind of litigation which it has spawned. I'm not sure whether board of directors, tax community is a different issue, tax professionals community within industry and elsewhere, but I'm not sure the board of directors really care that much, as long as they get certainty on a moderate rate.
I can tell you, Mr. Chidambaram and Arvind Modi, both of them who authored the tax code, were completely flooded with corporate India wanting the tax exemptions and ready to go with that 33%.
I'm saying it's a debate worth having on tax policy.
So
I'm
at the
not
moment,
concluding either way.
Maybe not. I don't know whether therefore anything can be expected immediately on that. But maybe the debate could restart.
And just one last point, is if we do continue, and you are right that the common consensus is we should continue, then there is a tax sacrifice involved. It is there in the budget papers year after year. I personally think the only way in which the tax uncertainty at the administration level can be mitigated, because you do have tax targets, etc., will be how effectively the tax base be expanded. We just can't have a same tax base, continue with the exemptions, ask for more SOPs, then we will certainly have more tax uncertainty.
Okay, Sachin, actually, to get into the conversation. Sachin, anything specific on indirect taxes that you expect, and then generally, of course?
Well, the current budget is in the backdrop of the Make in India campaign rhetoric. It is going on every day. We are finding one or the other news about the Make in India campaign. So we expect that if you have to support this Make in India campaign, the first and foremost thing is that to take necessary steps to make the doing business in India easier. So in this budget, I expect that first and foremost is there is some certainty about the biggest reform which is expected, that is GST. So we expect that in this budget, the finance minister should lay out a clear way forward for implementing GST, and industry require it very badly because they have to get ready. Should we intend to implement GST from 1st of April 2016, then the message should be loud and clear, and then we should move faster. So this is one thing. And if you see the last year's budget was more or less, it was a bureaucracy's budget, because the new government was finding its feet. So various provisions which is introduced in the last budget was actually regressive. There was a free run for the bureaucracy. For example, now the restrictions imposed on availing Senvad credit. You can't take the credit if you are not taken the credit within 6 months. This is one of the very regressive provision. Then they introduced a 30% interest, which even applied to even a disputed taxes if it is held to be payable, which is completely off the way. And then they also put restrictions on availing credit, and that created more and more disputes. So there are other areas like exporters refund. Now today every industry is reeling under the cost of working capital, and at this point in time thousands of crores of refunds are pending in various forums across all the cities. And every exporter is worried about when is this money going to come from the government. So when you are talking about doing business in India and making India an attractive destination for manufacture, the first and foremost what we expect is that this budget would bring in some of those provision which would take away those restrictions they have put forward in the last budget. And also that there are various other scenarios where the taxing of transaction between HO and head office, though it is actually between two same company, there is when the branch or HO is overseas, they're supposed to be taxable.
Okay.
So, amount of restrictions, amount of exceptions, which is actually creating a lot of litigation. And not only that, the tax department become very active nowadays, and even senior officers like CEOs and the CFOs have been called for taking statements, etc. There has to be some amount of risk-based grading of the assessees, and if somebody is very having a good record, tax record, then they should be treated with respect.
Okay, let me get Mr. Kanabar.
Okay. Just one clarity. I think you are flashing that the EY's views on MAT on FPI. It's the other way around. What I am saying is not MAT on FPI. What I am saying is that the clarification that FPIs will not create a taxable presence in India like the FIIs will also be extended in this budget, the other way around. I'm not saying that the expectation is MAT will be extended to FPI. I think MAT will not be applicable to both FII and FPI is a clarification. Exactly the opposite.
Okay.
And one more thing, I'm saying that, as I said, to encourage investment management companies to set up in India, you will find hopefully you will find a clarification saying for both FIIs and FPIs, you are welcome to set up companies without creating a taxable presence.
Yes.
So it's actually quite the opposite.
Yes,
Yeah.
gosh.
Okay, we'll make that change right away. But Mr. Kanabar, just coming to you, what are the steps do you think the government will take to increase the ease of doing business? Sachin spoke about a lot of issues, but in your own mind, what are the most important steps that we could watch out for?
There are a couple of things which require actually a fundamental change. Your question to me is what will happen in this budget, and I'm not really sure whether a lot of it will happen in this budget. But we are all aware as to how this target-based revenue collection being provided to tax officers is resulting in creation of artificial tax demands. So you have an economy growing at a particular rate, you have tax targets going up by much higher than that, you do not have an expansion of the tax base, and the only way a tax officer is going to meet his target is by creating artificial income and artificial demands, many of which get knocked down in appeal. That's number one. And the question is, can we change that fundamental philosophy that a tax officer is supposed to collect just tax dues, no more, no less. There is no point in trying to give a target to him which he has to achieve. That's issue number one. And I do not see that mind shift happening, but I would very much suggest that mind shift happens. Number two, Sachin spoke earlier about how some of the provisions have become very draconian. And if I may just take service tax as an example, where powers of arrest have been granted. And sure, there should be a power of arrest if a person has collected taxes and not paid to the government. But today, this power is being used indiscriminately to summon officers, to summon officials of the company and make them pay taxes which are otherwise not due. No multinational ever wants headlines flashing to say CFO or CEO arrested. And that is being used, if I may say so, rather indiscriminately, and that does not go towards ease of doing business. We are all aware that in terms of the global parameters, India is probably somewhere around 143 out of 168. And what needs to happen is simple things on the ground. The way there needs to be a trust which is built between the taxpayer and the revenue. Unfortunately, that doesn't exist today. We haven't spoken about the retrospective amendment, which tends to be a pet subject for everybody. But leaving just whether this budget will do away with the retrospectivity, I think in the last budget, the finance minister did a very nice thing to say on a going forward basis, I assure you that I will not bring anything retrospective. But the overhang still remains. For example, just take this issue which I had raised earlier about minimum alternate tax on SEZ. You start up SEZ, you say I'm going to give you a tax-free regime and then bring a book profit tax on it. So really when you speak of doing business, ease of doing business, how are you cutting down the red tapes? How are you ensuring with people that profits which are due and which can be remitted out are remitted and you don't go on? So and just one last point here, we spoke about incentives. I don't think corporate India needs incentives. In fact, much of the incentives are hardly provided with the amount of litigation that happens.
Absolutely.
So again, how can we provide certainty around that?
Fair points. Actually run out of time. Very sorry that we couldn't carry on with this discussion, but that's a wealth of points that you've already put on the table.